with the low rates that we've seen this year, because obviously everyone is very worried about the global slowdown and the fact that interest rates might be cut in the US, that means that interest rates have gone down, and that means that in a way the discount factor means that actually people are prepared to pay up a bit more for some of the more defensive companies, such as the sort of standard food producers and other such companies which have a slightly modest organic growth, but it's obviously usually very defensive in a downturn. And those multiples have gone up, we think, really quite significantly. On the other hand, there are companies which are seen as less defensive, but actually we think actually they are quite resilient. And some of those companies on a very low price earnings ratio. For example, something like SPIE is a French-based, but you might say now more pan-European outsourcer. And we saw their shares come back quite significantly last year, and actually they've bounced quite significantly this year. But even so, they're still on a PE of 10, and in 2009, the sales only fell 3%. So it isn't actually that cyclical, but people perceive it to be, and therefore that's why it's on a PE of 10. But actually we think this is a very good business, and the management own nearly 10% of the shares, so it ticks all our boxes, and we think there's a huge amount of upside in that. There are some sectors, or you might say some themes, that we seem to end up favouring. So a few years ago, we started to meet IT services or IT distribution companies, which we wouldn't normally have invested in beforehand, because some of their returns to that date had not been so good. But actually, with a lot of changing IT, some of these companies have been able to get very nice, resilient growth. So for example, we have quite a few holdings in this area, such as Cancom and a company called S&T, and also Atea, and also a company called Dustin. And they're all doing, well, they would say obviously they're all very slightly different to each other, but from an outsider's point of view, they look fairly similar, which is that what they're doing is selling IT hardware along with services. And actually, this is growing quite nicely, and they also sometimes have quite high market shares in their certain geographies. And so, for example, something like Atea is big in Norway, and for a large competitor, big IT distribution company, it's very difficult to imagine to distribute in Norway, because you've got obviously most of the population living all the way up a sort of 1,000-kilometre coast. So it is actually quite a difficult and quite small market to distribute in, and therefore actually they have quite nice barriers to entry. But increasingly they can add on other services. So for example, Cancom, if you're already selling the IT equipment to a small and medium-sized company in Germany, then actually when you're there, you've sort of got a free sales person that can also upsell, for example, doing their cloud outsourcing at the same time. And so it's a very nice way to grow, and also that growth is much more recurring, because once you've sort of locked in the customer with the outsourcing model of the cloud and essentially the IT infrastructure, you then have a nice recurring sales revenue in the future. So some of our favourite holdings do fall into certain themes. So for example, we quite like testing and inspection, and we have probably about 5% in 3 different companies one called SGS, which is in Switzerland. We also have another one in France called Bureau Veritas, and a recent addition which is only about 1% and a bit at the moment, because we're sort of adding to it, is called Eurofins Scientific, and that's also based in France. And actually all 3 have about 30% controlled by families or by the founder. So actually in the case of Eurofins, it's 30% or 36% is controlled by the founder and CEO himself. And the reason we like these is that in 2009, for example, they all had organic growth, even though the rest of the world obviously was in recession. And that's because essentially here is regulation is your friend, so more and more things need testing, and they can benefit from that. In general, we have very low turnover, so on average we hold things about 4 years, but actually that's as usual an average, and there are some things we've held actually since the launch of the fund in 2009. But in the last sort of 6 to 9 months, we've taken profits in Scout24, which is a bit like the equivalent of Rightmove and Auto Trader in Germany, which was bid for by private equity. And we've also added a position called Fineco, which is a little bit like Hargreaves Lansdown, but based in Italy. When stocks have done very well, often they re-rate, and sometimes that means that the valuation for us is too expensive. So if, for example, the PE goes quite a bit above mid-20s price-earnings ratio for this year's earnings, then that usually triggers a definite inspection as to whether it should be sold. Sometimes, though, some companies have a lot of net cash on their balance sheet, or they have a very high dividend yield, or in other words, a high payout ratio. And actually that might mean that we don't necessarily always sell it completely if it's on, let's say, 24, 25 times PE, because it might also have a sort of 3.5% dividend yield at the same time. But that's one reason, is the valuation. Secondly, if management changes or if the strategy changes very dramatically, then if that's cause for concern, we might also sell. And then other times it might be the long view is not looking good. For example, we used to own something called Loomis many years ago, and that does cash handling, which is in a way a good business because it's consolidating the outsourcing of all the cash handling. So banks and companies and cash machines, etc., they just outsource it to Loomis. But obviously, as we all know, using contactless every day, I mean, some people almost don't actually have any cash on them at all. So you can see that even in the short term, they might be okay because actually people are still outsourcing, but over the long term, it might struggle when actually cash use starts to decline.